Do you want to build serious wealth while everyone else is spinning their wheels? It all comes down to one game-changing decision: commit to long-term investing. Here's the truth most people miss. The stock market doesn't care about hype, hot tips, or lucky breaks. It rewards something far simpler: patience, discipline, and smart strategy. Even Warren Buffett, arguably the greatest investor alive, has said it. Most people would crush it by simply owning the right ETFs and letting the magic of compounding work in their favor. Instead of chasing hot stocks or guessing market moves, ETFs give you instant access to the strongest companies driving real growth. A high-quality growth ETF captures businesses expanding at extraordinary rates, while dividend investing adds a second wealth engine: reliable dividends that pay you regardless of market conditions. This powerful combination fuels growth, income, and long-term stability. Most people make investing harder than it needs to be. They follow noise, jump in and out of positions, and sabotage their own results. But once you understand how to invest using a small number of elite ETFs, everything changes. In this video, I'll reveal the top 4 ETFs that create the fastest, smartest path to building wealth in the stock market, with confidence, simplicity, and momentum. I will show you and Bobby these unique ETFs in reverse order. The first ETF is considered by several well-revered investors to be the best cash flow machine. I will show you how each of these ETFs can turn a one-time investment of $25,000 into $1 million. One particular ETF that could turn a $25,000 one-time investment into a whopping $4 million. If you want steady growth, compounding returns, and a system that fits real life, these unique ETFs could completely change how you invest. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Firstly, let's discuss why my personal strategy is to always include a combination of growth and other ETFs. While growth ETFs are the engine of wealth creation, targeting companies expanding faster than the broader market and driving long-term capital appreciation, stability-focused ETFs provide the foundation that keeps a portfolio resilient during market downturns. These funds generate steady income, reduce volatility, and preserve capital when growth stocks pull back. The combination of these ETFs provides a disciplined, durable strategy to compound wealth through every market cycle. With that, let's dive into these unique ETFs. Claiming the 4th spot on our list is the Schwab US Dividend Equity ETF, ticker symbol SCHD. If there's one ETF that genuinely deserves the title cash flow machine, it's SCHD. This ETF isn't built for hype or risky yield chasing. It's built to pay you reliably, grow your income, and protect your capital. This fund focuses on one mission: owning high-quality businesses that generate real cash and consistently reward shareholders. SCHD doesn't guess. It screens for companies with strong balance sheets, durable cash flow, and at least a decade of uninterrupted dividend payments. From there, it ranks them on financial strength, profitability, dividend yield, and dividend growth, ensuring only the most resilient businesses make the cut. The result is a tightly constructed portfolio of 100 stocks, diversified across defensive sectors like consumer staples, healthcare, energy, industrials, and financials. Inside this unique ETF are household names such as Coca-Cola, Home Depot, AbbVie, Amgen, Lockheed Martin, and Verizon, companies that have survived recessions and kept paying investors through it all. That resilience shows in the numbers: nearly a 94% total return over 10 years, a current dividend yield of 4.04%, and a powerful 11.3% dividend growth rate. With an ultra-low 0.06% expense ratio, SCHD keeps fees out of the way and income flowing. Well, as the saying goes, numbers don't lie. So, Let's calculate the future value of SCHD as a lump sum investment. We're starting with an initial investment of $25,000 with no additional contribution. We will use the current annual share price appreciation of 8% and a starting dividend yield of 3.80%, which grows at 11% per year. All dividends are fully reinvested back into the fund. The methodology behind this calculation accounts for the increase in dividend yield each year from the 11% dividend growth rate. In year 1, the total return equals 8% from share price appreciation plus 3.80% from dividends for a total of 11.80%. By year 2, the dividend has grown by 11%, so it becomes 4.218%, making the total return 12.218% when combined with the 8% price appreciation. In year 3, the dividend grows again to 4.682%, bringing the total return to 12.682%. This pattern continues with the dividend yield accelerating each year, and the compounding effect becomes more powerful as the dividend yield grows. This same methodology will be used for all the remaining ETFs. Now, let's dive into the 10, 20, and 30-year projections for SCHD. For the 10-year projection, the average effective return is approximately 13.20%. To calculate the future value, we multiply $25,000 by 1.1320 raised to the 10th power, which equals 3.453. This gives us a future value of $86,325 after 10 years. For the 20-year projection, just repeat the process. The average effective return increases to approximately 13.85% due to the growing dividend component. We multiply $25,000 by 1.1385, raised to the 20th power, which equals 11.92. This calculation results in a future value of $298,000 after 20 years. For the 30-year projection, the average effective return continues to climb to approximately 14.60% as the dividend yield has grown substantially over 3 decades. Multiplying $25,000 by 1.1460 raised to the 30th power gives us 56.86. The final future value after 30 years is $1,421,500, demonstrating the remarkable power of dividend growth and compounding over an extended period. Claiming the second spot on our list is the Invesco Nasdaq 100 ETF. Ticker symbol QQQM. If you want pure growth without the stress of stock picking, QQQM is a powerhouse you can't ignore. This unique ETF gives you instant exposure to the most dominant innovators in the stock market. Companies like Apple, Microsoft, Amazon, and the next wave of market leaders still climbing the ranks. This is growth investing simplified and supercharged. Over the past year, QQQM has delivered eye-opening results, posting roughly 23.66% and averaging about 20.33% annually over the long term, closely mirroring the performance of the Nasdaq 100. That kind of consistency doesn't happen by accident. These companies benefit from strong balance sheets, massive pricing power, and recurring revenue models that fuel long-term profitability. While technology is the core driver, this unique ETF isn't a one-trick pony. It also includes meaningful exposure to consumer discretionary, healthcare, telecom, and industrials. An important layer of diversification that helps manage risk when tech cools off. And here's the kicker. QQQM tracks the exact same index as QQQ, but with lower fees. At 0.15% versus 0.20%, more of your money stays invested and compounding. Instead of guessing the next breakout stock, QQQM gives you a single, efficient vehicle packed with proven winners and tomorrow's innovators, working for you around the clock. Next, let's dive into the numbers for QQQM. We'll calculate the future value of QQQM with an initial investment of $25,000 with no additional contributions. We'll be using a conservative annual share price appreciation of 12%, starting dividend yield of 0.49% that grows at 11% each year. All dividends are fully reinvested back into the fund, Following the same methodology used for SCHD, the average effective return is approximately 12.95%. Therefore, for the 10-year projection, we'll calculate the future value by multiplying $25,000 by 1.1295 raised to the 10th power, which equals 3.376. This gives us a future value of $84,400 after 10 years. For the 20-year projection, the average effective return increases to approximately 13.50% due to the growing dividend component. Therefore, we'll multiply $25,000 by 1.1350 raised to the 20th power, which equals 11.40. This calculation results in a future value of $285,000 after 20 years. And for the 30-year projection, the average effective return continues to climb to approximately 14.15% as the dividend yield has grown substantially over 3 decades. Multiplying $25,000 by 1.1415 raised to the 30th power gives us 50.91. Therefore, the portfolio's final future value after 30 years is $1,272,750, demonstrating the remarkable power of dividend growth and compounding over an extended period. Stick with me, because shortly I will show you one unique ETF that can deliver a whopping $4 million. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Claiming the third spot on our list is the Vanguard Information Technology ETF, ticker symbol VGT. If you want direct access to the engine powering the modern economy, VGT puts you in the driver's seat. The special ETF is designed for investors seeking concentrated exposure to the companies shaping the future, and the results speak loudly. VGT has delivered a whopping 27.9% over the past year, and an eye-popping 23.45% annualized return over the last decade, outperforming most broad market alternatives. What makes VGT especially powerful is its depth. You're not just owning mega-cap giants like Apple, Microsoft, Nvidia, Broadcom, Oracle, and Palantir. You're also capturing mid- and small-cap innovators. These are the hidden gems that often grow into tomorrow's industry leaders, giving you upside that many investors miss. VGT is laser-focused on actual information technology companies, meaning every holding plays a direct role in software, hardware, semiconductors, or IT services, the core infrastructure of today's digital world. And because it's managed by Vanguard, efficiency is unmatched. With an ultra-low 0.09% expense ratio, more of your money stays invested and compounding year after year. Despite market volatility, VGT has thrived thanks to recurring revenues, expanding margins, and relentless innovation. For growth-focused investors, this ETF isn't just exposure, it's acceleration. Now, let's check out the 10, 20, and 30-year projections. We'll calculate the future value of VGT with growing dividends for a lump sum investment with no additional contributions. We're starting with an initial investment of $25,000 with no additional contributions. The share price appreciation is expected to be 12% annually, with a starting dividend yield of 0.40% that grows at 11% each year. All dividends are fully reinvested back into the fund. Still using the same methodology used for the previous ETFs, the average effective return at year 10 is expected to be approximately 12.91%. To calculate the future value, we multiply $25,000 by 1.1291 raised to the 10th power, which equals 3.361. This gives us a future value of $84,025 after 10 years. For the 20-year projection, the average effective return increases to approximately 13.46% due to the growing dividend component. We multiply $25,000 by 1.1346 raised to the 20th power, which equals 11.30. This calculation results in a future value of $282,500 after 20 years. For the 30-year projection, the average effective return continues to climb to approximately 14.10% as the dividend yield has grown substantially over 3 decades. Multiplying $25,000 by 1.1410 raised to the 30th power gives us 50.29. The final future value after 30 years is $1,257,250, demonstrating the remarkable power of dividend growth and compounding over an extended period. Claiming the top spot on our list is the Invesco S&P 500 Momentum ETF, ticker symbol SPMO. If you want to ride the strongest trends in the stock market, SPMO was built precisely for that purpose. This ETF doesn't guess or speculate. It systematically loads up on the best performing stocks inside the S&P 500 and cuts exposure to the laggards. This is momentum investing done with discipline and precision. Here's why SPMO stands out. Every 6 months, it analyzes the past 12 months of price performance across the entire S&P 500. The stocks with the strongest momentum receive the largest weights, while weakening names are reduced or removed. The result? A portfolio engineered to stay aligned with what's actually working in real time. The performance speaks volumes. SPMO is up 34.51% over the past year, has averaged 18.53% annually over the last decade, and is crushing it year to date at 28.21%. These numbers highlight the power of trend-driven markets. Yet despite its aggressive edge, SPMO remains diversified, holding around 100 large-cap stocks across multiple sectors. Even better, it does all this with a lean 0.13% expense ratio, keeping more of your capital compounding. Designed for higher highs and shallower drawdowns, SPMO delivers a rare blend of speed, structure, and control, making it one of the most compelling momentum ETFs available today. Now, let's dive into the 10, 20, and 30-year projections for this unique ETF. We'll project the future value of SPMO using a one-time lump sum investment with no additional contributions. The analysis begins with an initial investment of $25,000, with no additional investment. The fund is assumed to deliver 19% annual share price appreciation, starting with a 0.60% dividend yield that grows at 11% per year. Every dividend payment is fully reinvested back into the fund, allowing compounding to work over the long term. Still maintaining our previous methodology, the average effective return at the 10-year mark is expected to be approximately 20.36%. To determine the future value, the initial $25,000 investment is multiplied by 1.2036 raised to the 10th power, resulting in a growth factor of 6.199. Applying this factor produces a future value of $154,975 after 10 years. For the 20-year projection, the average effective annual return rises to approximately 20.82%, driven by the accelerating impact of dividend growth over time. To calculate the future value, the initial $25,000 investment is multiplied by 1.2082, raised to the 20th power, producing a growth factor of 38.43. This results in a future value of $960,750 after 20 years. Now, extending the analysis to the 30-year projection, the average effective return increases further to approximately 21.37%, as the dividend yield has compounded significantly over 3 decades. Multiplying $25,000 by 1.2137 raised to the 30th power yields a growth factor of 190.71. This produces a whopping final future value of $4,767,750 after 30 years, clearly highlighting the extraordinary power of long-term compounding and dividend growth. Think about that one more time. All this from a one-time investment of $25,000. Now here's the real question. Which of these ETFs fits your style? None is better or worse. They're simply different tools built for different goals. Once you're clear on what you want, speed, income, stability, or growth, the right choice becomes obvious. Or maybe you're like me and prefer the power of combining all of them into one unstoppable strategy. Drop a comment below and tell me which approach you're taking. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.